Good afternoon. My name is Joseph Fischera. I am a visiting lecturer here at the Woodrow Wilson School, class of 1976 and beyond. And it is my honor to introduce Gretchen Morgenson, I think a person whose career has been dedicated to the same ideals of rigorous analysis, wisdom, and illumination that is the core of this school and indeed of this university. Her career has crossed paths with good and bad for many Princeton graduates. Most recently, her career was with Steve Forbes, which I'll mention briefly, but also with James Johnson in Fannie Mae and her recent book. She is from the heartland, actually was born in Pennsylvania, then went deeper into the heartland and graduated from St. Olaf College in Minnesota with a degree in English and history in 1976, and went to Vogue magazine, but then thought, well, what was really in vogue in the 1970s was finance, and she went into finance and quickly co-authored The Woman's Guide to the Stock Market, and then became a broker in 1981 with Dean Witter Reynolds. Now, then and there, it might have been a different story than I'm going to say today, but for Gretchen's skills, determination, and her character, because while the biggest bull market in the history of the country began just 1 year later in 1982 when I joined a Wall Street firm, which also was at Dean Witter, in 1984, she decided not to reap the rewards of a big brokerage firm, but to bridge the gap between those who knew finance and those who needed to know finance. She went to Money magazine, then to Forbes magazine, and then to Worth magazine. And as I said to her before, for some inexplicable reason, except for the fact that she was on staff for Steve Forbes, a Princeton graduate, she became his presidential press secretary in 1996 when he had some strange ideas about a flat tax without scholarship. But that we won't bring that up at the Wilson School. But I'm sure that was what we call an LE, a learning experience. She wrote on finance and got inside the thinking of finance. Her book in 1997, Forbes' Great Minds of Business, was just part of her continued research of the what and why of finance. And it was then in 1998 that the New York Times persuaded her to come there. She immediately was confronted with the first of many financial crises from an increasingly opaque and confusing market that even the so-called masters of the universe couldn't understand. In her first year at the Times, in '98, she investigated the crisis of academia, finance, and leverage in a group called Long-Term Capital Management. Her reporting then earned the 1998 Gerald Loeb Award from the New York Times. Now, Loeb was the founder of E.F. Hutton, for those who remember, whose famous tagline in commercials was, "When E.F. Hutton talks, people listen." How foreshadowing it was that in her first year at the Times, she would receive this award, and how her career in understanding the markets and then explaining them would continue. She is not just one who is to report on what other people say. She is one to dig deep into what they say, what they mean, what they didn't say, and what needs to be said. And she developed her voice, and by 2002 was awarded a Pulitzer Prize in journalism for, quote, trenchant and incisive Wall Street coverage. Now, for those like myself who didn't really know what trenchant meant, a quick internet definition, it says, expressed in a forceful, direct, and effective way. Synonyms: sarcastic, biting, clear, critical, forcive, insightful, incisive, powerful, and direct. Antonyms: indirect, flattering. And in 2009, The Nation called Gretchen the most important financial journalist of her generation. So her weekly columns give a voice to those who need an avenue to raise questions and seek answers and want accountability. And in her most recent book, which I hope you have looked at, called Reckless Endangerment, and that shows she's an academic, because there's a colon in the title, how outsized, not just average, outsized ambition, greed, and corruption led to economic Armageddon. She goes in depth on the government-sponsored entities, and Jim Johnson, who's a great Princetonian, is laid bare in that as well. So it is with my pleasure to introduce Gretchen and say, if Gretchen Morgan did not exist, who else would there be in financial journalism? I mean, we have Paul Krugman, but he's really an economist. We have various other folks, but we need in journalism people who can say it in plain English and be the candle in the darkness, and it is my pleasure to introduce Gretchen Morgenson as that person.
Thank you so much, Joe. I'm really honored to be here this afternoon. This is a privilege to address such an esteemed crowd at the Woodrow Wilson School. What Joe didn't tell you in that wonderful introduction is that he has actually helped me make quite a bit of trouble here and there by being a wonderful source who is so good at explaining some of the really arcane and perplexing instruments that Wall Street has come up with in recent years. So you can run, but you can't hide, Joe. You've been a big help to me. In my remarks today, what I'd like to talk with you about is explore where we stand right now, given that we're about 3 years after one of the most upsetting, disturbing, perplexing, and baffling episodes, I think, in financial history. The disastrous autumn of 2008 unfolded, I don't know about you, but as I was sitting in my desk at the New York Times, it was really an unbelievably harrowing period of time. And even though I was supposed to try to explain it to people, there was so much that we did not yet know, and even to this day, do not know. So I've often explained to people who ask about what my job is like that it's become something like being an archaeologist, because we're still digging amongst the kind of wreckage of what happened and dusting off shards of pottery and trying to put them together into a puzzle that really helps explain what happened. Certainly, there are 3 elements that I'd like to bring up with you today about where we stand. One is where we stand on the economy 3 years later. Another is where we stand vis-a-vis regulation of financial services, especially important given that the lack of prudent regulation really contributed to the crisis. And finally, 3 years on, where we stand vis-a-vis accountability for those involved in the crisis, in creating it, in enabling it, and in the aftermath. So starting with the economy, I know that I certainly would have hoped that by this time, 3 years later, we would be well out of the woods, economically speaking. But the fact is that this is a different kind of crisis than we have experienced in recent years. We've almost grown accustomed to having financial crises erupt and then sort of go away relatively quickly. Long-term capital management was one of those. It was resolved relatively quickly. We moved on. The internet bubble was another. It didn't devastate people to the degree that this crisis really did. So I think a lot of people are often surprised about how we are still trying to climb out of the hole that we've dug ourselves. And really the reason is that this was a crisis that was built on debt, and massive, massive amounts of it. So what we're really going through is a very enormous and excruciating and protracted deleveraging process. So we are purging the debt. We're in the process of purging all of that debt that we took on during the anything goes late 1900s, late 1990s, early 2000s. And as a result, because the pile of debt that we amassed was so much larger than anybody had seen before, it's just taking an awfully lot longer to get out of this current malaise. Now, I think that you can see the pain in this process. Data from the government, particularly on the unemployment level, I think, is probably the best way to look at how much pain is still going on in the economy even now. Even though we've seen it decline in the most recent figures below 9%, we still have a tremendous number of people in this country who are not working or not working to the degree that they would like to be. This is very disturbing and really holding us back as far as the economic growth that we would like to see going on in the country. That the credit crisis and its aftermath continue to affect so many people, as I said, is, I think, new and disturbing and alarming to people. But this crisis is a more tenacious one because of the debt angle. This is a teaching moment on, of course, the upside and the downside of debt. During the boom years, of course, indebtedness allows investors to increase their returns. It's a wonderful thing. But then when you turn it on the other side, debt becomes a devastating device because the assets, even though their prices may fall, the debt that you amassed to buy those assets, whether it's real estate, whether it's stocks, bonds, that debt remains the same, even as the underlying asset prices can fall. So that is one of the hardest lessons that I think investors have to learn. It's certainly one that my former editor at Forbes, a brilliant magazine editor, said was one of the toughest. That is that the assets shrink, but the debt doesn't. So again, going back to this deleveraging process that we're going through, let's look at some of the figures. Let's see how long it takes to really work down this debt. Recent figures from the Federal Reserve show that at the end of June, household debt in the United States stood at 115% of disposable income. Now that was a good number. It's the lowest level since the second quarter of 2004. But it has only come down from 116% in the previous quarter. The all-time record, when we absolutely reached the peak of debt in this country, was in 2007, when this figure rose to 130%. That was twice the level seen one generation earlier. Another measure of the glacial process of deleveraging was, as of June, American households owed a total of $13.6 trillion on their mortgages, down from $14 billion in the same period a year earlier. This is a very slow process. Now, mortgages, of course, are by far the largest debt typically held by a household, but our credit card obligations, our car loans, and other consumer loans are also considerable. Today, these debts stand at $2.5 trillion, and to get back to what some economists call a sustainable level, they would have to decline by as much as 20%. If our goal is indeed to bring debt down to a more manageable point, we would have to return our debt to disposable income levels to about 78%. Remember, we're at 115. Beginning in the early 60s, for example, if you look back in history, through the mid-90s, the nation's debt to disposable income remained sort of in a range of 58% on the low side to 85% on the high side. Then, of course, it did the moonshot. Now, this debt binge by the American public in the 2000s was not simply to buy Viking stoves and to take trips to Europe. Remember that throughout the 90s and the early 2000s, personal incomes were pretty much stagnant, while the costs of health care, college education, and real estate were rising. So consumers were really forced to withdraw money from their homes to cover the difference between income and outflow. They did this through generous home equity lines and second liens that were offered to them by aggressive home lenders. When I was co-authoring Reckless Endangerment, we went back and looked at some of the figures during this period, and they are simply staggering. In 2005 alone, homeowners extracted $750 billion from their homes. During the 3 years of 2005, 6, and 7, borrowers were extracting, again, between $600 billion and $800 billion a year from their homes. Now, of course, while the real estate bubble was expanding, all of these borrowings were secured by the properties underlying them that were increasing in value. Now, of course, these borrowings are unsecured because the real estate assets beneath them have plunged in value. And so you have legions of homeowners across the country carrying mortgages that far exceed the value of the property underlying them. According to CoreLogic, a research firm, 11 million mortgages nationwide, or 23% of properties, were underwater on their mortgages as of September. 60% of properties in Nevada are underwater, versus 49% in Arizona and 45% in Florida. Obviously, we have a long way to go in the deleveraging process, but how long really will we be stuck in what feels like a massive unwind of this debt? Some economists say that if we keep at the relatively recent pace of household income growth and debt work down, it might take 8 years from start to finish before we return to equilibrium. A McKinsey Global Institute study of past deleveraging episodes showed that the typical downshift lasts 6 to 7 years. So we've lived through 3 very painful years already. If these estimates are correct, we've got about 4 years or so remaining in the process. So that's where we stand on the economy. How about regulation? This is a critical question, of course, for anyone interested in avoiding another financial mess like the one that we're still climbing out of. The failures of federal regulators to police the lending industry and big banks was, of course, central to the creation of the crisis. On the one hand, the United States government wanted to promote home ownership. It was thought to be a greater good, something that would benefit everyone. It was a noble cause, perverted, of course, by the bankers and Wall Street's securitization machine that came later. But even as the government put this forward as a goal that everyone should pull together to achieve, nothing was done to protect borrowers from what turned out to be some very rapacious lenders. The scales in this whole process of promoting home ownership were decidedly tipped in favor of what I call the housing industrial complex and against the borrower. So I think that we can agree that this should not be allowed to happen again. The collateral damage of borrower evictions, unemployment, ruined lives, lost savings is just too large a price to pay. And don't forget those people who benefited from the crisis, executives of lenders who sold their shares before the end of the line, brokerage firms that profited mightily from buying and selling toxic loans to their customers. But the beneficiaries were few, and those harmed were many, which is another reason why we must all say never again. And yet our legislature's response to the mess, the 2,000-some page DoddFrank law, did exceedingly little to address the single biggest issue that we face. That is, how to eliminate the threat of institutions that are too big and too powerfully political to be too politically powerful to be allowed to fail. Even though the existence and clout of such institutions were directly responsible for the financial panic of 2008 and its attendant economic woes, too big to fail is, I'm afraid to say, alive and well in America, in spite of Dodd-Frank. This is one of the more disturbing paradoxes of this disaster. So Dodd-Frank runs to thousands of pages, yet its failings are significant. It does not, for instance, say a word about Fannie Mae and Freddie Mac, the mortgage finance giants that were central to the crisis. It does not deal with too big to fail in any significant way, and it delegates massive amounts of rulemaking to regulators. This last bit provides financial services firms and their armies of lobbyists with yet another chance to manipulate the law's final outcome. By contrast, we have GlassSteagall, the Depression-era law that protected consumers and investors quite ably for almost 70 years. It was 34 pages in length. So how big a problem is too big to fail? Well, take a look at a Bloomberg analysis that showed that the largest U.S. banks have grown ever larger since the financial crisis. These bailout-ready banks will increase by 40%, Bloomberg said, over the next 15 years. This is because Dodd-Frank it does bar the nation's banks from merging with one another, but it does not stop institutions from growing in other ways. Since the financial crisis took hold, for example, the banking sector has grown 7 times faster than gross domestic product, Bloomberg said. Today, the top 10 banks in the U.S. hold 77% of all U.S. bank assets, compared with 55% of total assets in 2002. This increase has outpaced inflation in every decade since the 1930s, when total assets in the banking system were first recorded. Tom Hoenig, the former president of the Kansas City Federal Reserve Bank, and the nominee for vice chairman of the FDIC, is among the few policymakers willing to speak out about the continuing problem of big financial institutions. Another is Richard Fisher, president of the Dallas Fed, who advocates cutting large banks down to size, to a level or asset size or leverage size that makes them more manageable. Sherrod Brown, a Democratic senator from Ohio, has co-sponsored a bill to cap bank size and leverage. But these are 3 relatively lone voices on the subject in Washington and on Wall Street. Dodd-Frank also supplies a loophole that will allow even the largest banks to buy troubled institutions in times of crisis, thereby again growing in size and peril. A section of the law lets large institutions, even those who are subject to limits on concentrations of assets, buy failing banks if regulators approve of the deals. I don't know about you, but I find it hard to believe that a regulator would say no to such a deal the next time a crisis hits. Another disappointing aspect of the Dodd-Frank law is that it confers a special status on institutions that are seen as systematically important, aka large, interconnected, politically powerful. The process to resolve big bank failures is specifically targeted to, well, big banks. What this means is that smaller institutions will be allowed to go bankrupt without a new resolution scheme. So this is a very unfair system, particularly if you're a small community bank. It sends a pernicious signal, too, I think, to the market about large and intertwined institutions. Subject as they will be to the newly codified resolution authority, these institutions and their lenders can expect to be rescued if they get into trouble. Of course, this perception that they will be bailed out delivers lucrative advantages to these institutions, the main one being lower borrowing costs, a result of investor assumptions that these giants are less risky because they will be in line for government assistance if they become imperiled. Think Fannie Mae, think Freddie Mac, both of which assured taxpayers throughout the 90s and into the 2000s that they would never cost us a dime. So in spite of these Dodd-Frank failings, I think you've probably heard this many times, taxpayers have been told repeatedly that this law ends too big to fail institutions. But market participants well know that these large institutions will in fact be rescued if they get themselves into trouble. That was the singular message of the events of 2008. Even the rarely perspicacious credit rating agencies recognize that government support for big institutions is here to stay. Last January, S&P said that when rating banks, it would include the prospect of government rescues as a factor in determining the grades that they would receive. Moodys quickly followed suit, stating that the resolution regime proposed by Dodd-Frank, quote, will not work as planned, posing a contagion risk and most likely forcing the government to provide support to avoid a systemic crisis, end quote. As a result, Moodys said it would assume government support for the nation's 8 largest banks. And so, thousands of pages of Dodd-Frank verbiage have left us perilously close to where we were before the credit crisis hit. We have no resolution plan for Fannie Mae and Freddie Mac. The regulators who are hammering out the Dodd-Frank machinery are being subjected to immense lobbying pressure. And most significant, we remain threatened by institutions that are too big to succeed. Finally, I'd like to turn to the issue of accountability, one of the most disturbing aspects of this crisis and its aftermath. Americans, I believe, are rightfully outraged that those who created the crisis, both on Wall Street and in Washington, have taken no responsibility for the mess. In fact, holding the architects of this crisis accountable seems to have been proven to be just a bridge too far for both federal authorities and many of their counterparts in various states. Even more maddening, some of the regulators who failed spectacularly in their work during the lead-up to the crisis have been rewarded with even higher posts. Analyzing the financial crisis, its origins, and its framers requires identifying powerful participants who would rather not be named. It requires connecting dots that appear unrelated and identifying events that seemed meaningless when they occurred, but that have turned out to have been integral to the outcome. Investigating the origins of the financial crisis means shedding light on exceedingly dark corners in both Washington and on Wall Street. Hidden in these shadows are people, places, and incidents that can help us to understand the nature of this disaster so that we can keep anything like it from happening again. And yet, those types of investigations have not been forthcoming from either the Justice Department or from many local authorities. I think that fact has done a lot to feed the abundant anger and mistrust that I believe is across the country today. Given our government's rather central role in the crisis, I don't think it's a coincidence that there have been so few investigations and prosecutions of wrongdoing. Still, I think it disturbs many people that 3 years after this crisis that brought the economy literally to the brink, that no one has gone to jail as a result. I think it's hard to believe that a debacle this big, this momentous, this far-reaching, which generated hundreds of billions of dollars in losses, jettisoned millions of people from their homes, and threw our nation into recession, that all of this involved no criminal activity. Now, I am not a lawyer, I am not a prosecutor, I don't have to make cases. I know it's very difficult to do, and you have to prove that people knew what they were doing, there was an intent to defraud. All of that is extremely important and difficult to do, I warrant. But at last count, only one relatively high-level mortgage official has been sentenced to jail time arising out of a fraud that is crisis-related. That person is Lee Farkas, who led a $3 billion fraud while running a lender called Taylor, Bean, and Whitaker. He was sentenced to 30 years in prison. Now, that's all well and good, but neither Farkas nor Taylor, Bean, and Whitaker were major contributors to the housing bubble. I don't know if any of you saw the recent 60 Minutes episode. There were actually two, in which they interviewed Lanny Breuer of the Department of Justice to ask why there had been so few prosecutions. On camera, he claimed, not very credibly, I thought, that the agency was hard at work on these cases, that it takes time for these cases to develop. Undoubtedly true. Said that there were going to be a variety of cases coming down the pike. He declined, of course, to describe them. But experts point to numerous questionable activities where criminal probes might have borne fruit and possibly still could. Why, for instance, haven't they examined the failure of executives to fully disclose the scope of the risks on their books during the mortgage mania? Or the amounts of questionable loans that they bundled into securities and sold to investors, loans that they knew were toxic and were about to default. Prosecutors might also pursue evidence that executives knowingly awarded bonuses to themselves and colleagues based on overly optimistic valuations of mortgage assets, in effect creating illusory profits that were wiped out, of course, by the subsequent losses. And yet there have been very few clawbacks of compensation that was earned during the crisis when these assets were rising in value. Now, again, perhaps Lanny's right. There will be indictments coming. That's very possible. But I think that until they do come, people will continue to believe that very few people have been held accountable for this mess. And there is a fear, I think, among many people that there may be something a little bit pernicious at work here. Perhaps a concerted effort to protect some of the primary participants from prosecution. This is not an idle concern, given that so many high-powered players were involved in the questionable practices that led to the crisis, many hailing from Washington and Wall Street. It's true that digging too deeply into the mess could touch some mighty participants. One might well ask whether the government wants to identify who did what during this episode. With regulators such as the Federal Reserve, the Office of Thrift Supervision, the Comptroller of the Currency, and the SEC deeply involved in the practices leading up to the crisis by allowing poisonous lending and freeing up balance sheets to greater risk-taking, a hard-nosed government investigator could very easily wind up probing some friends in high places. It's my belief that many people in Washington know that if they launched a full-blown investigation of this meltdown, the spotlight could fall on them. Dennis Vaako, who was an attorney general in New York during the 90s, spoke to this potential problem when he told the Times that the government might not like the places that deep investigations would lead to. Quote, "Once you start pulling the string through in these complex cases," he said, "you might be surprised what you find at the other end." Now, I think one way to look at this particular situation that's extremely educating is to look at what happened in the SNL crisis of the late 80s and early 90s. Our current situation, in fact, stands in stark contrast to what went on during that episode of bank fraud. Hundreds of banks failed in the wake of that crisis, but almost immediately special government forces were set up to examine, to prosecute, to bring these perpetrators to justice. These task forces referred 1,100 cases to prosecutors, resulting in more than 800 bank officials going to jail. Many of these jailbirds were former chief executive officers, not lower-level flunkies. Among the best known, of course, was Charles Keating of Lincoln Savings and Loan in Arizona, and David Paul, head of SunTrust Bank in Florida. Now, there's another data point that I find interesting in the 1990s because of its stark contrast that it provides. At that point in time, the President of the United States, Bush the first, got up on his legs and made it clear that ferreting out financial fraud in the S&Ls was a top priority of his administration. In speeches, he advised, he told the Justice Department, go after these cases with vigor. Fast forward to the current crisis, and we find the opposite approach. In the spring of 2008, just as the storm was gathering, the FBI actually scaled back a plan to assign more field agents to mortgage fraud. That summer, just weeks before the collapse of Fannie Mae and Freddie Mac, Lehman Brothers, and AIG, the DOJ also rejected calls to create a task force devoted to mortgage-related investigations. That left these very complex cases undermanned and poorly funded. Only much later did the Justice Department establish a more general financial crimes task force. Now, some prosecutors that I've spoken to have argued to me that the types of fraud that were perpetrated during the SNL crisis were far easier to litigate. Those cases, they said, were characterized by embezzlement, plain vanilla self-dealing, other bad behavior that's relatively easy to identify and expose. And of course, this time around, I will say that these instruments that contributed to the crisis were incredibly complex and complicated, which may have stymied investigators. I don't know. Wall Street loves complexity. It keeps them in business and keeps them in profits, and so it's not surprising that these instruments were as Byzantine and mind-numbing as they were. But it will be very disturbing, I think, if we can conclude from this episode that the way you escape any kind of accountability, whether it be legal or criminal or civil, is by simply designing the most impenetrable instruments that you can get away with. Now, one, I think, of the key elements that has contributed to this lack of prosecutions, again, comes from prosecutors that I've spoken with, and it really makes sense to me. What they say is that the regulators, in the years leading up to the crisis, when everything was hunky-dory and mortgages were being written to anybody with a pulse, regulators were not on the job collecting the kind of data that they need to have to be able to refer to criminal prosecutors to amass solid cases. So we all, of course, knew at the time, or know now, that the regulators were refusing to rein in these practices at the time that they were going on. This, of course, led to the crisis and to a lot of the failures. But what I think I didn't understand, but now do, is that this regulatory failure had a second impact. And that is that it meant that these regulators were not collecting the data necessary for prosecutors to build successful criminal cases. So in effect, the same dynamic that helped enable the crisis, weak regulation, also made it harder to pursue fraud in the aftermath. Now let's go back again to the SNL crisis and see how important regulatory referrals were to successful prosecutions. Once again, in that crisis, the FBI opened 5,500 criminal investigations on the strength of regulatory referrals. And again, as I mentioned before, these brought forth 1,100 prosecutions of major bank fraud and resulted in 839 convictions. So I believe that a more aggressive mindset among regulators could certainly have spurred more prosecutions this time around. That certainly is the view of William Black, a professor of law at the University of Missouri in Kansas City, and also the federal government's director of litigation during the savings and loan crisis. Black said that the relaxed regulatory approach in the current episode, quote, created an exceptional criminogenic environment. There were no criminal referrals from the regulators, he said, no fraud working groups, no national task force. There has been no effective punishment of the elites in this crisis. Instead, we have had silence from the highest levels of the government. Michael Mukasey, a former federal judge in New York who had been the head of the Justice Department less than a year when Bear Stearns collapsed in March 2008, discussed at that time setting up a task force with deputies, according to 3 people who were briefed on the talks. But he decided against it, announcing this decision in June 2008. We all know what happened just about 2 months later. Now, there have been some attempts to put some money into these cases. 2 years into the crisis, for example, Congress passed the Fraud Enforcement and Recovery Act, allocating $165 million to the Justice Department and FBI for new financial crisis cases. But Congress quietly took away all but $30 million of that allocation subsequently. So, put together, all of these actions contribute, I think, to our current and frustrating situation where participants in one of the biggest economic disasters in history seem to have skated away from the scene untouched. I don't know about you, but the sense of shame and the sense of shared sacrifice just really seems to have gone missing among some of our leaders in this country. And I'm talking about private sector and public sector. So even as the government has thrown trillions of dollars into the system to mitigate the impact of the downturn, Millions of people have been forced from their homes, lost their jobs, and I think a damaging result is that trust in the nation's regulators and in some of our largest and most venerable institutions has been shattered. Equally disturbing, I think, the failure to put resources into law enforcement on these cases may confirm a dangerous suspicion that some Americans hold. That is, that there are two sets of rules in our nation. One for Washington and the powerful companies that contribute to their reelection campaigns, and one for the rest of us. I would like to close before the Q&A with what I think is the most compelling and on-target quote that I have found to really summarize what I think so many people are feeling today about the crisis and the aftermath. It comes from Frédéric Bastiat, the 19th century French economist and writer. He said, quote, "When plunder becomes a way of life for a group of men living together in society, they create for themselves in the course of time a legal system that authorizes it and a moral code that glorifies it." End quote. That, I think, is what we are all up against, and we must not allow it to prevail. Thank you very much.
We have time for questions. We have two microphones here. We would like the students. Which one is yours?
Mine.
Okay. We have some students first from my undergraduate and graduate days, and they're still here. I think we have one coming down. Slowly but surely. You can get there. Yes?
Nobody likes to be
All right.
first, right?
Thank you, Gretchen and Professor Fischer. You mentioned the government's role in regulating moving forward, but when you talked about the process of deleveraging, the painful, slow process of deleveraging, one thing that my classmates and I are working on is where the government fits in unraveling the problem and helping people whose homes are underwater. So where do you see government agencies at the state level, at the federal level, fitting into that process?
Okay,
Thank
so the
you.
question is, what do I see the authorities, federal, state, doing to help homeowners?
Yes, current homeowners, stabilize neighborhoods where there are homes in foreclosure, helping individual homeowners. Is that something that government should be addressing? Or as Mitt Romney said, is that something that we should just let it hit the bottom?
Well, I think that the government has tried to respond in several ways. After they had rescued the banks and made it clear that the financial system was what their first priority was, there were several, programs set up by the Treasury to try to help underwater homeowners, troubled borrowers, et cetera. I mean, they always were badly designed. They always had the feeling of an afterthought, something that people really weren't that interested in doing. It really contributed, again, I think, to this feeling of two sets of rules, that big, powerful institutions get immediate assistance and, individuals don't. So I think that the government has really mishandled a lot of their response to this crisis. And I wish I knew exactly why, because these are obviously smart people, who understand, I hope, the markets. One of the problems that is really holding any kind of blanket effort back is the complexity of these loans, the securities that they're in, the fact that some of these loans are held by banks, some of them are held by investors. You can't force investors necessarily to mark down the value of mark down a mortgage that you could if the government made that decision and the government owned all the loans or the banks agreed to do it. There's so many different, parties involved that have to agree to any kind of a rethink of this, whether it's principal write-down program, extending a borrower, lowering the rate of interest that they pay. It's been very difficult to get everybody at the table. But I think, again, there's a sense of mistrust among investors who hold these mortgages and securities because they've been really screwed by some of these programs that have gone on, in the past. So they're rightly concerned about it. One of the things that I think could have been done early on that wasn't and that still has not been addressed is the issue of second liens, many of which are held by the major banks who service these mortgages, who service the first loans on the same properties. And the second lien problem is that we all know that these are worthless. We all know that these underwater mortgages mean that if you have a second loan, that's absolutely worthless. But the banks haven't written them down, and the banks haven't been forced to write them down. And so the fact that nobody actually sort of structured a deal to maybe give them forgiveness or forbearance to write these things down over time in the government, that the government didn't say to the banks, look, we'll let you write down these, we're going to make you write down these mortgages, but we'll let you take it over a period of 10 years or something like that, so you don't blow a huge hole in the capital of the bank. The fact that no one has addressed the second liens, even now, it's such a fiction that they're even on the bank balance sheets where they are. That would have been a great way to start, because then you would at least have a homeowner that doesn't have two loans on the property that's, far, far underwater.
I'm sorry to ask
Yeah,
a
go
quick
ahead.
follow-up. If someone were to address that, who would that be? Would that be the state attorneys general pursuing cases? Would that be the federal government executive branch?
I think it would
be
have to be the
Congress?
federal government.
Okay.
Give them a holiday, the banks some sort of forbearance to write these things down without having a big, huge capital hole blown in their sides. Because it's like $400 billion of second liens held by the major banks that are servicing, loans across the country. So it's a huge, huge problem, but it's standing in the way of dealing with the first mortgages that really are the crux of the issue.
Thanks.
We had another Princetonian, Elliot Spitzer, and the state attorney general being aggressive. Do you see any, following up on that question, any state attorney generals taking a different stance than just deferring to the federal government? I mean, why aren't the states more involved in fraud? Because they're violating. Why does it just have to be a federal statute?
The response by the state attorneys general, that's a really good question, Joe. It has been really disappointing. In fact, when it really became clear that there were a lot of foreclosures that had been put forward using phony documents that had been filed with the courts, this is the so-called robo-signing epidemic, the state attorneys general, I mean, that's a fraud on the courts. That should be pretty clear, and you want to be aggressive with that and really want to understand the depths to which those practices, really poisoned the, entire property law and, in fact, transfers of property. You would want to know, I would want to know that if I were an investigator. But these state attorneys general immediately went to the table and started negotiating with the banks on a settlement on those issues last year, just about a year ago, without having conducted any investigation into the, extent of the problem. And I have written columns asking the question, how can you negotiate aggressively with the banks on the other side of the table if you don't know the degree to which the wrongdoing, the amount of wrongdoing or the extent of the wrongdoing? So it seems to me, Joe, that from the beginning, when they did have an opportunity to really, act tough and be tough on behalf of their residents and borrowers in their states, they just really caved in. Now you're starting to see some of them peeling off from this so-called 50-state settlement talk. Massachusetts, Martha Coakley, just filed a very aggressive suit against the major lenders. She has chapter and verse. It's a 60-page complaint. She's got a lot of evidence that she's turned up in her investigations about the extent of these practices, and she really wants the banks to she wants to be able to extract something significant from the banks, but also to, get a series of practices that they agree to that, could not abuse homeowners to the degree that they've been abused with these other practices. So you're starting to see one or two come forward, but for the most part, Joe, it's been really disappointing. There hasn't been any leadership in that regard.
Rachel?
Hi, thank you so much for coming. My question is, I read recently that the rate of innovation in financial services outpaces the rate at which we can regulate.
Outpaces
the rate at which our legislature can actually do anything, regulate. What do we do? I mean, we're here to be policymakers and facilitate that process, but if the question is obvious.
Well, certainly Wall Street is always a step ahead of the people who are policing them. The best and the brightest go into financial services. It's rocket science. People have brought immense amounts of brainiac stuff to Wall Street in devising these instruments. I think sometimes with an eye to obfuscation, but that's just my view. So
Don't be trenchant.
I'm retrenching. So, coming up with what is the regulatory framework that you can construct that will be able to keep up with that kind of innovation? Well, certainly it would require people who are as intelligent as the people who are in the banks. They certainly would have to have an appetite to regulate, which we certainly saw did not occur in this crisis. They should not be co-opted, captured. This is an immense problem in the regulatory world. Capture the idea that you're a part of their group, you're not an adversary, you're not on the outside of the party, you're actually in the party with the people you're supposed to be policing. Huge problems. So any kind of structuring of a regulatory framework, it seems, should address those issues. I think one academic that I've relied on for a lot of very good advice and guidance is Ed Kane at Boston College, and he was very involved in the SNL crisis, and he actually helped the government devise or understand the amount of the implied subsidy that Fannie Mae and Freddie Mac had from the government before they went wild in the mid-'90s. Very intelligent guy, very concerned about regulatory capture. And he believes that there should be like a regulator's sort of academic or a university or some sort of a regulatory school that produces the kinds of people that will have the appetite to regulate, that won't be captured, that look at this as their life's work, that they really would want to do, and that are trained to be, as up to speed as the Wall Street people that they're policing, sort of almost an academic approach to regulation. But I don't hear anyone talking about changing regulation or changing the framework in Washington, and it's so clear that it needs to be changed that it's kind of discouraging.
How much of the fact that you did work on the other side, and you did work for Steve Forbes, you did work for the gray side at least, if not the dark side, that helps you now in being a critic and understanding. I mean, so for policymakers to go, your answer there was about an academic approach with people that probably wouldn't come from the industry. For the fact that you were in it be better, and are they able to pull people from the industry?
Well, I think they only pull people from the industry who either have spent their entire careers there and have this feeling that they're going to do public service, which is not necessarily wrong, but it's not necessarily maybe the attitude that you have. They're imbued with the whole, mindset, which is part of the capture, I think, that happens with regulators. I mean, I think that regulators in the years leading up to the crisis, it was all about believing the bankers when the bankers would tell them that, look, we don't need high capital ratios. We understand our business. We would never bet the bank on any of these products. What do you think, we're nuts? Leave it to us. We have models that show, what the loss potential is here. And the regulators really bought into that over that period and started relaxing it and, allowing certain securities to have, much lower risk weightings, which meant that you didn't have to put any capital against them. And so, again, it's a mindset that's a mind meld almost between the regulated and the regulators. One of the people that I write a little bit about in Reckless Endangerment is Barney Frank, because he was a very vocal and very long-standing supporter of Fannie Mae and Freddie Mac. He believed that housing was the noble goal. He had, he was supportive of the companies throughout, almost really to the end. And there were many times when he would castigate the regulators that were charged with trying to oversee these behemoths. Now, I'm talking about the 90s, well before they got into trouble. But, so I was talking to him. At one point, I said, why were you, he would be so tough on anybody who would criticize them, and anybody who would even ask the question of, is it right to be delivering a housing subsidy through these private sector, third-party, institutions who then have the ability to extract billions of dollars from those subsidies for themselves. Anybody who criticized it, he would shout, scream, yell, and I said, and the regulators came under intense battles with him. And of course, he's very smart and a very, tough prosecutor. And I said, Barney, didn't you feel like, why were you so tough on these people? They were just articulating the point of view that they were afraid of safety and soundness issues in the country. He said, well, these regulators were acting like adversaries. They were adversarial. I said, well, yeah. They're supposed to be adversarial. I didn't like that. I didn't like the fact that they were adversarial. I was just astonished that he thought that they should be friends or something. I don't know. But anyway, so again, it's this sense that there is that we can't have tough people asking tough questions and being persistent or, it really was all about protecting the taxpayers, after all. So.
Jennifer? Right now. Just talk.
You can come up here.
I'll be able to read.
Hello?
There it is.
Thank you.
Okay, so the moral code.
Right, the moral code, and what we do about that, I guess, that glorifies certain behavior and see success in a certain way. And then, for instance, I was talking with an undergrad activist here. I didn't do my undergraduate here, but she said that, and I haven't verified these statistics, but that 40% of Princeton undergrads who go into the workforce go to Wall Street. And what was almost more disconcerting in that is that she said a lot of people right now, especially with the economic downturn, feel that that's the only option. So I guess both of those things.
Well, I think that there's no doubt that the financial services industry has grown far faster than many other industries in this country. And there's nothing wrong with that if these institutions are producing value, something of value for a great number of people. If they are simply shifting paper around in dark corners to produce profits and revenues for themselves and their shareholders, then there's something wrong with that picture. And I would argue that, I think that the growth and the sort of dominance of the financial services industry in this country has contributed to this kind of question about the moral code, because this is an industry that is very bottom line oriented and extremely filled with extremely smart people. who have really one goal in mind. I mean, it's about making money for these people. It's not about anybody else or anything else. And, that's okay. I don't have any problem with that, but it really needs to be balanced. If you're going to have institutions like that taking risks, and then the taxpayer is going to have to pick up the pieces when the risks go wrong, then that is absolutely a recipe for disaster, and that's what we've seen. But I think the acceptance, the sort of glorification of financial services in this country has been disturbing to me, because it doesn't necessarily create value. In the days when these investment banks allowed companies to go public, to create shareholder wealth, to contribute to job creation in this country, then I would say absolutely let them, grow big and strong and do that till the cows come home. But it's really been sort of morphed into something more about proprietary trading for their own accounts and putting together these really cockamamie instruments that are designed to benefit the sellers of the instruments, confuse the buyers of the instruments. And in fact, in the case of these mortgage instruments that were designed to fail, I mean, that just brings it to a whole new level. If you're designing something that's going to be toxic so that you can bet against it at the same time that you're selling it to your customers, I mean, I think that is the quintessential example of how Wall Street has lost its way. It's no longer about job creation. It's no longer about capital formation. It's about creating something that can generate profits for a very small slice of the population. And that's a problem.
And contribute to annual giving. So, student over here.
This is kind of along the lines of financial innovation, but how does the government control leverage ratios or even reserve ratios when things like sweep accounts and overnight repos are instruments that banks are allowed to use? No one really knows the amount of reserves that any one bank has. So I guess this problem was created from like GlassSteagall forward, but I don't know what your thoughts are.
Well, I think that if you're talking about institutions that are insured, that are depository institutions.
FDIC approved.
I'm sorry?
Institutions that are FDIC
Yeah.
approved that have to follow.
I mean, that
reserve
is a
ratios.
huge problem, because the government, or in this case, the FDIC fund, which is, of course, funded by the banks, so they should be equally concerned about this, although they probably just pass along the cost to the customers. The degree to which proprietary trading, losses that, emerge in their operations, the degree to which that is then insured or has to be shored up by the FDIC fund, that's just a huge problem. Again, it's the same dynamic of privatizing gains and socializing losses, which is so repellent and so really un-American, or it should be un-American. As far as capital ratios, leverage ratios, I mean, I think that, yes, you can confound regulators, and yes, you can confuse regulators. But I think that if you have some pretty strict and, basic rules in place, and some regulators who are willing to enforce them, then you would not have this kind of free-for-all. And I think you look at Europe as a really good example of a far worse situation, because, they were always arguing for greater leverage. They were always arguing for lower capital than the FDIC. And so in a way, our bank failures and our bank's problems were less than what you're seeing in Europe right now. So I'm a believer that you can structure leverage ratios, capital ratios in a way that's intelligent and that can be enforced, that can protect the taxpayer. So I'm a believer in that, but it has to be, all those elements have to be involved. They have to be intelligently conceived, and they have to be enforced. And those are two things that we just didn't see in the years leading up to this crisis.
We have about 5 more
Thank you.
members from the community, except your class of 2012.
Yes, well, I may be a senior citizen, but I do have a question. Well, but I have an answer, an easy answer to your question why we haven't jailed these
good.
people. Because
Tell me.
we can't have all our job creators in jail.
Fair and balanced thing.
Yeah, well, I do have a question for you, and that is, as I understand, the trickle-down theories and the Reaganomics and everything just seem to be a failure to me. The numbers I've heard is about 70% trickles down. That means that that's really a bad policy, it seems to me. Am I correct on that? Do you have figures
I don't
on
know. Joe,
what
do you know?
happens
When you
here?
say what's trickling down?
Well, for instance, very low tax rates. Yeah, no, I haven't gotten it. But the idea that we have to just keep reducing the rates for capital gains and wealthy individuals and so forth, so that they'll create jobs out of that money. It doesn't seem that $1 going toward that's going to produce at most 70 cents worth of jobs. That's what I've heard, but I don't know.
Well, I think that, there's absolutely proof positive that there has been so little job creation, even with the, huge tax benefits that large corporations now receive. I mean, I think one of my colleagues has done some very good reporting on General Electric and, the tax benefits that they receive. And, they've just been essentially cutting jobs or shipping them overseas. And, so I would agree that that does not seem to be the prescription for job creation. But you also have to keep in mind that the consumer is in a very bad way still because of the debt binge that we talked about. And so even if you were to hire people to create something, if there isn't someone to buy it, then those jobs are not going to remain extant for long. So this is a very interconnected problem. You have to get the consumer's balance sheet in better shape before they're going to be willing to spend again. And of course, they account for the lion's share of GDP in this country. So, it's what comes first, the job creation or the consumer balance sheet. I think that we know that the balance sheet is going to take a long time to recover. And frankly, companies have just way better profit incentives to ship jobs overseas, even now with China, rising or gaining in some of the employee, the incomes over there. But there's no doubt it has not translated to job creation. So I don't see how that can be an argument going forward right now.
From the financial services industry, I think Paul Volcker said the only financial innovation he saw came out of the industry was the ATM. So that's Paul. And the fact, though, is also that in 2007, I think, 37% of all corporate profits came from the financial services industry. And the question is, what did we really produce other than pieces of paper and other things?
Or losses.
Good, which we offset against gains in the future, of course. A student, again, we'll go back and forth here.
Really appreciate all of your great insight tonight. I have a quick question about the Consumer Financial Protection Bureau. Recently, the Senate rejected the president's nominated the director that he would like to that he wanted to place there, and it looks like, according to a Business Week report this morning, that there will not be an opportunity for a recess appointment later this year. What is your outlook for this agency going forward, and I guess this bureau more specifically, and do you see it really being able to affect any positive change without a director, given that so much of the banking abilities for it to regulate would not be possible without a director?
Okay, the question is about the Consumer Protection Bureau that's been set up under DoddFrank, that was Elizabeth Warren's concept when she was at Harvard. I think that, this is going to be a battleground for a long time, because this is the thing that the Republicans have said they really object to. I mean, there's a lot about Dodd-Frank that they don't like, but this is like, it's a visible thing that they can, really take potshots at. So if you don't have a director, it obviously is a hobbled agency. It's an agency that doesn't have a leader, and so the sooner we get one, the better. But I mean, I think the importance that this Consumer Protection Bureau will play is it will add a consumer element to the regulatory framework that was absolutely non-existent in the years leading up to the crisis. The only regulator that was kind of routinely worried about safety and soundness was the FDIC, because, of course, they have the insurance fund that they have to worry about. So, you know, the degree to which they were monitoring far more closely was related to the fund, but the Fed had no interest in the consumer, zero. There were so many misses that they, you know, could have really taken up and, you know, helped protect. There were laws on the books. There were regulations that nobody was enforcing. So what the Consumer Finance Protection Bureau brings, I think, is a focus on the consumer, on protecting the consumer that was completely AWOL in the years leading up to the crisis. So I think that's a good thing. Now, whether it's overkill, whether it's too big, whether it's going to grow into something that costs hundreds of billions of dollars a year, I don't know. But they do need to have a consumer element to the regulatory framework, because we saw what happened when they don't.
Very good. Let's have, I think we have one or two more questions. Been very good. It was a good, concise question. So, yep.
What is your sense of the exposure of the too-big-to-fail banks today to the serial sovereign debt crises in Europe? And do you think the American public will have the stomach for another Wall Street bailout?
The answer to the second question is easier, I think, because the answer is no. I don't think they will have a stomach, but I don't think they'll be asked, unfortunately. Now, as far as the exposures to the sovereign debt crisis, this is a huge problem because, again, the disclosures are really lacking. The banks are all across the map. Some of them are better than others. Some of them will, they will say in their 10K or their Q, we have an exposure to the pigs, you know, Portugal, Ireland, of X billion.
Portugal, Ireland, Greece, and Spain.
Italy, no, Italy soon to be.
All right.
Anyway, no. So they will tell you what they are assessing as their exposure, but it, I think, is completely not trustworthy, because these are the same people that told us the mortgage exposure was not problematic. And, you know, one of the aspects of the sovereign debt crisis that is extremely difficult to plumb is the insurance that has been written, that has been sold on these exposures. And so these banks will say, well, if you net out the insurance that we're carrying against defaults on these nations or on the banks that have a lot of investments or a lot of loans out to these nations, then we're pretty square. We're okay, we're not exposed. But the question is, who is on the other side of that insurance? Are they money good? And so it's really an unanswered question. And I think this is why bank stocks are trading at these very low multiples, because people don't trust them. People don't believe when JP Morgan or Citi or any of them say our exposure is nominal. It's just not credible. And it requires all of these assessments or assumptions about insurance holding up and the counterparties holding up and not being caught in a contagion, event like AIG was, where it ended up having to be bailed out because of these very insurance CDSs that were written. So I think that the banks have not been forthcoming about their exposures. The degree to which they have been forthcoming, I think investors don't trust. And so everybody's waiting to see what happens.
Thank you.
Question over here, I think the last question, and then I'm going to have it.
Last night, President Obama was interviewed on 60 Minutes, and he was asked how come there haven't been any prosecutions. And I was interested in his answer. He said, well, I can't talk about specific cases, But basically, most of these people, if they may have done things that are abhorrent, but they didn't do things that are illegal. So I wonder how you would react to that.
Well, how does he know? Has he examined all the behavior and all the filings and all of the, I mean, that's one of those questions, that's one of those answers that's just not credible. I mean, maybe it's true, but does anybody believe that there was a full-blown investigation of every one of these companies that was determined that there was no illegality and that there was no criminal behavior? No, there has not been. And so whenever anybody, whether it's President Obama or DOJ officials say there was no criminality, I'm sorry, I'm not a buyer. Unless you tell me what you did, how you, investigated every one of these companies, Countrywide, Lehman Brothers, IndyMac, WAMU. I mean, it's so obvious that these investigations have not taken place. How can they determine that there was no illegal behavior? It's entirely possible that it was just amoral behavior, and it was just gray area or cutting corners, and that they didn't do it with scienter. But it's hard for me to really believe when someone stands up and says that without knowing, knowing that they didn't conduct full-blown investigations. How do they know that there was no criminal wrongdoing?
Yes.
Thank you.
I try to ask everybody who speaks in my class and others, what are you optimistic about?
Well, I'm optimistic.
Positive.
I'm optimistic we will get out of this. We will climb out of this mess. I am a big believer in American ingenuity. I just hope that it can be used and deployed in industries that do actually create value and create worth. So I'm a believer in America and the American tradition, and I just think that we're going through a terrible period where trust has been so shattered that it's very difficult for the President of the United States to get up and say there has been no criminal behavior and for people to believe it. So trust is so easily lost and hard to win back. I don't know how that's going to happen, but I know that if we just, I believe that there are many companies out there who are doing the right thing. I do. You don't hear about them. I don't write about them. But the dominance of the financial sector and the havoc that it wrought really on the economy, on human beings, on lives, on foreclosures, has been so devastating that I think it's going to take some time before you can, trust some of these large institutions, whether it's private sector or public sector. But I am positive. Ultimately, people say, oh, you're such a cynic, you don't have anything nice to say. Well, if I didn't believe that we could do something about this, I wouldn't do what I do. You've got to try to make a difference.
How many words is one of your typical columns?
About 1,000 words, 1,100 words. Not a lot of space.
Like a 3 to 5 page paper, just for all your students out there. Every week. So
Every week.
Thank you very much.
Well, thank you so much for your, really appreciate it.
Continuing to write